Hello, it's annual general meeting season again, when shareholders have the opportunity to meet with management and discuss the year just gone. And particularly companies in the oil and gas industry will have a lot to talk about, because it's in the last year that we saw the price of oil fall quite dramatically, from around $100 a barrel to only about $50 a barrel. And while the price has stabilized, clearly that had an impact on earnings last year. Among them, Swiber, which is in the engineering, procurement, installation and construction business, EPIC for short. This is a company listed on the Singapore market in 2006, has been around since 1996, and the impact of the price of oil, or the decline in the price of oil, is certainly felt in the 2014 financial year. The company has operations in the Asia-Pacific, Middle East, Latin America, and most recently in West Africa. And as you can see here on page 8 of the annual report, it has 13 vessels that help oil majors, oil companies, go about the business of producing oil, particularly in shallow waters. And that's going to be important for reasons that I'll explain in a few moments. But the key theme that you'll get out of this 140 or so page document is the fact that the oil prices had fallen, stabilized more recently, but clearly more volatility ahead. And also, particularly in Swiber's case, that they have restructured some of their subsidiaries, as well as some of the leases governing some of their vessels. On page 15, we find the chairman's report, and in particular this comment here, which says that the changes in the oil and gas industry, which I was just talking about, have inevitably had a knock-on effect on the oilfield services supply chain, in other words, Swiber's core business. And that impact was certainly felt on the financials. Let me take you through them briefly. Let's turn to page 59 of the annual report, where we see the revenue figures here. You can see down from more than $1 billion to around 726 million, so a very substantial decline. The cost of those sales also fell, but not fast enough, and as a result, we see the gross margin falling from more than 16% to less than 3%. So you can see, once again, very substantial impact on the company, on the business, in fact, as a result of the decline in the oil price. The net profit number also came down, although what you don't see shining through here, or what's not transparent immediately, is how this number came about. Yes, a big decline down to 1/3 of what it was a year ago, but also embodied in that is a 30% decline in administration fees, which the company says is testament to the fact that their restructuring efforts have paid off. Also boosting that bottom line, it has to be said, is the divestment of some of their businesses. You can see the other income line on a net basis going from more than $60 million to more than $100 million. So that obviously contributed to the bottom line, helped to prop it up even as their core business was suffering due to the changes in the industry. The share from joint ventures and associates was also higher, and you can see that here in this graphic. And all of this really comes back to the fact that Swiber says that it's not as impacted as some other players in the industry. And here's the reason why. Again, back to the chairman's statement, where Raymond Kim Goh says the impact on shallow water projects is expected to be less than deep water activities, because the shallow water activities generally tend to be less capital intensive, tend to be cheaper. And also, the group services are not heavily employed in the exploration stage of the oil and gas value chain, which means in essence that Swiber really only comes in once the funds have already been committed. And once the oil majors or their customers have decided to go ahead with certain projects, that's it, they're committed, and Swiber continues to be in there. So they're at the part that's not at risk of being cancelled. In other words, if the oil majors are cancelling some of their exploration activities, it's not going to hurt Swiber terribly much, because they only deal further down the line anyway. The order book is also looking very good, $1.4 billion, a record for them, largely driven by 2 contracts which they've won just in the last couple of months. In late 2014, they got this deal here, $710 million worth, based in West Africa, but the customer is actually in Houston. The project should last them through to around 2017. And therefore we've still got another year and a bit for this revenue to come through. And the second line you see there, $310 million worth. That was booked in South Asia by a repeat customer who they've done quite a number of projects with over the several years that they've been with them. And while that came after the close of the financial year under review, obviously they're highlighting that as part of the reason for why, as at the end of February, the order book is looking so strong. Let's take a look at a couple of other key highlights from the financials. Here we go. These are the cash flow hedges, page 87. If you're an accounting buff, and more explanation on page 88 as well. You see the cash flow hedges worth several $100 million. Just looking at the fair value gains and losses has gone from a gain to a loss, although there's a tax implication as well. It gets a bit complicated. Read the annual report. Back to page 57, and in particular, some of the items pertaining to cash. Here we see the end of 2014 cash balance up at 176, up just slightly from the same period last year. And it was net cash flow that helped. Page 63 for that, the cash flow statement showing that they actually registered a cash inflow of around 33 million as opposed to an outflow. And you would expect that, given that this company, this business, is very capital intensive, and profit and cash flow don't necessarily go hand in hand, because sometimes they have to invest in order to make the profits later on. Over to page 101, and that's where we find mention of bank borrowings. Now, once again, Swiber's a little bit complicated because it's not just the banks that they loan money from. They also have various bond and other notes out there. Again, read the annual report for full details. The net debt to equity ratio is about 1.52 times, according to the annual report. So again, you would expect to see quite some focus at the AGM on their debt position. You can see here bank borrowings alone up slightly, but overall, once again, please pay attention to the notes and some of the other ways that they raised capital in the past. Over to page 41, because this is something all shareholders always want to know. How much did the senior executives get paid? Here it is. Page 41 shows you that there were 5 executives, including Chairman Raymond Kim Goh and Francis Wong, the Chief Executive, together with 3 others, receiving more than $500,000 in remuneration. What you also see in the leftmost column there is that about 40% of that is in basic salary. The rest really comes about from performance bonuses, a little bit of directors' fees, as well as some of the other payments, other benefits, as it says there. Overall, the company spent $330,000 on directors' fees last year, and if you turn to page 133, you'll find that that's going to stay for the next financial year. At least that's one of the resolutions at the annual general meeting, where in fact it's resolution number 3, where they're asking for directors' fees to be maintained at that sum. Also, resolution 4 is what you'll be asked to vote on if you're a shareholder, asking for PricewaterhouseCoopers to be reappointed as the auditor. PricewaterhouseCoopers earned just shy of $500,000 from their relationship with Swiber last year. Resolution number 6 asks you to approve the issuance of shares of up to 50% of issued capital. Resolution 7 asks you to approve the buyback of up to 10% of issued shares. Once again, read the full annual report for all of the details, and here are the details of the annual general meeting of Swiber.